Good afternoon, ladies and gentlemen. Welcome to this preparation class. Right. When we are preparing for this test, there are things that we should know as we go for the test. Our main focus will be on basic things about what is an audit, maybe the requirements, those like regulatory requirements, the King 4 code, preliminary audit engagement activities, risk assessment, materiality, audit strategy, and audit plan. So those are the areas that are highly likely. Of course, I don't believe in spotting, but we can always make a more emphasis on identifying the risks, maybe checking if the risk is high, the magnitude and the likelihood, and also knowing your risks at financial statement and at the assertion level. Then also you should be able to calculate materiality, both planning and performance materiality. And you should also be able to create an audit plan and also make up an audit strategy. So those are the things that we should be able to do as we go for the test. So some of the things that I've spoken about are the ones that we are going to look at. So we'll look at some of them. We'll be using the document that I've sent to you. I don't think we'll be able to exceed it, but if time permits, we can always also find another one, but I doubt that very much. Right, so let's look at the document that we are using today. All right, the following information relates to the audit of Living Well Private Limited, which is Living Well. All right. Required. Refer to the background and materiality information of Living Well when answering the following questions. So they will be based on the background and the materiality. All right, number one, discuss whether or not the CFO complied with the fundamental principles of ethics as stipulated in the SICA Code of Professional Conduct. Note that your answer does not have to address the threats. So there's no need to address the threats. It's just stating the principles, fundamental principles that the auditor will have failed to comply with. And I think we know that we've got integrity, objectivity, confidentiality, there is professional competence and behavior. Right, so our auditor is supposed to comply with all of those fundamental principles. I think you can refer to our previous classes, you can be able to see them. Right, so we have to go there and see if there's anything that questions the integrity, that questions the objectivity, that questions the confidentiality of the audit. Right, let's go and read what they are saying here. Right, you are a third-year trainee accountant employed at a medium-sized audit firm, namely ISA Incorporated. Most of the audit firm's audit clients operate in the retail sector, of which none of them are listed companies. Living Well approached your audit firm to find out whether the firm will be interested in accepting them as an audit client. The chief executive officer of Living Well indicated that they want to build a strong, long-standing business relationship with the firm and therefore are looking for a firm that will be willing to perform the audit for the current and following financial years. Living Well is in the business of selling natural and organic health products from a warehouse situated in Pretoria. The company has been in business for the past decade and has been consistently profitable over the previous financial years. Living Well's turnover for the 2021 financial year is reported as 5 million, budgeted 4.9 million, reported 4.5 million. The company is not capital intensive and does not own the warehouse from where they operate. The company sources its products from both local and international wholesalers, and therefore also must comply with various local and international laws and regulations. So from our knowledge, from our previous classes, already you should know that here you are talking about what some of the risks that can be involved. They are sourcing their products both locally and internationally. That means they might be trading in Forex, which can create a risk there, and also must comply with various laws and international laws and regulations. They can also create a risk there. To make sure that all laws and regulations are adhered to, Living Well as an exceptional team of legal advisors would advise them on all legal requirements and changes thereto on a regular basis. To deliver products to some of Living Well's major customers, the company owns a fleet of mini trucks. Right, so those are the mini trucks. Right. I think we'll start from let me just check, because there are some things that we have looked at. Just a second. I just want to see where we cover. Just give me a minute. All right. Question 13A, are those the ones that we did? Roshan, I think I saw that you wrote question 13BA. Okay. All right. This part, I think we've done it. You check it in our previous classes. And the number 2, I think we are on the. Is it number 4?
Sir,
yes.
Can't we do it? Can't we start over and do it and do everything here, because some of us were not in class?
No, you have the recording. Remember that we did it on Thursday. You can refer to the recording there. It's rather better that we do this, then I look for something else. Then that one you can always go on the recording. Rather that you just repeat everything all over again. So it's rather better we finish off this, then you can always refer to the recording, then I will be able to look for something else which is similar. I'm not saying that I won't do that completely, but then I will have to do something else other than to just repeat what we did the other week.
Say,
Yes.
Mr. Eugene.
Yes.
I just want to ask. I saw like I also when I've gone through the recording, but I don't remember you discussing the fundamental principles.
Is there also it's a different recording when we did the fundamental principles?
Yes, like when we were doing this question also, like this one of number one, where this one which says discuss whether or not the CFO complied with the fundamental principles of ethics as stipulated in SICA Code of Professional Conduct.
We did the SICA Code of Professional Conduct.
I know, but I'm talking about this particular question. One.
Yes, because even Thursday when we were doing this, you said the 1 and 2 we did it, and you didn't do it. You didn't touch it.
We did.
Thursday.
No,
we
didn't
did
do
the
it
risk.
on Thursday. On Thursday we started from here. Like this one we did it first. Is that right? Sometime back we did this part. Is that right? And this one on their own. Is that right? Then on that Thursday that you're talking about, we started from here on number 3.
Okay, so Mr. I just want, can you please just like if there's any like where you wrote that answer for that question 1 and 2, maybe after this class, and then you send it to us.
I think you already have them.
Okay, all right.
Can you go on the documents that I sent to you, the first ones?
All right. Yeah, let's continue.
You see, I want to avoid to just send the things on the group. That's why usually you see when you request something, I say go outside the group.
All right. It's okay.
Okay. Like what I want to try, my friends. I'm not saying I will not look at the fundamental principles. I'm saying it's that better we do something which we didn't do. Is that right? We finish off this, then I find another question which can help us like to do everything, like repeating everything. I don't think that it can give you value.
All right.
Unless you want me to repeat, I can repeat all over again. I don't mind. But I just thought that maybe you can do it. Then maybe let me repeat. That's what you feel.
No, it's fine. You can continue. You can continue.
I want to do what you want. Because some will feel disadvantaged then. But what I thought is you could refer to the recording. Then when I finish this, I can always look for something else. Let me just look at it quickly.
All right.
Let me just look at it quickly. All right. So let's okay. So let me focus on the fundamental principles right now. All right. I think to save on time, I will read the second part when we reach the areas that needs us to deal with that part. Right. First of all, you should know that if you are a registered chartered accountant, you will be bound by the code of conduct, SICA's code of conduct. So when you're asked such a question, when they ask you discuss whether or not the CFO complied with fundamental principles, the first thing normally when we answer such a question is to find out if the CFO is a CA. If the CFO is a CA, that means the CFO will be bound by the what? By the fundamental principles according to the SICA conduct. So you will be bound if you are a registered CA. So normally when we're answering such a question, we start from checking whether the CFO is a registered chartered accountant. Now we read here that the CFO of Living Well is a registered chartered accountant. So that will be our first part that we talk about, right? Right. So first of all, we have to state that the CFO, that is question one. Ethical principles. Right. So then we have to state that the CFO is bound by the SICA code of conduct. As he is registered as a chartered accountant. They actually give a mark for stating that. So that's the first thing. So as long as you are a CA, you are bound by the SICA code of conduct. You are supposed to adhere to it. All right. What I'm writing here aside is nothing to do with the scenario. I'm just trying to give you in general. Right. The fundamental principles. When they talk about fundamental principles, they are talking about the following. Integrity, objectivity, professional competence, and due care. Confidentiality. Right. And professional behavior. Right. When we are saying integrity, the professional accountant is expected to be honest in professional and business dealings. They are supposed to be honest and straightforward. Then when you talk about objectivity, they should not allow biases to impair their judgment whenever they do anything. Then when you say for professional competence and due care, they've got a duty to develop themselves and to make sure that they only do what they are able to do according to their qualifications and experience, and do everything that they do with extra care to ensure that they do it properly. Confidentiality, they should not disclose information unless they are required to do so. For example, if it's an investigation by the authorities and you are required to disclose information, you can, but you should not just disclose information of the client when you are not supposed to be doing so. Then a professional behavior, you should not do anything that would discredit the profession. Anything that will make people think that accountants are not, they don't do what they are supposed to do. Maybe that will make people not to trust the field of accounting. So you should not bring the profession into disrepute. That's professional behavior. So when they ask you about these principles, you have to check on your information if there's anything that threatens these fundamental principles. For example, you might be told that the CFO went and disclosed to a friend from another company information about the company. Or maybe in the scenario, you might be told that there is a problem and the CFO wants to, maybe there's a material misstatement and he wants it not to be reported. Maybe because they want bonuses and their bonuses, their profit will not be right. Or maybe they are taking a bribe, or maybe they were buying from a relative, but they didn't disclose and stuff like that. So those are the things we are going to look out for. So let's go and check if there's anything that can bring a question on all these fundamental principles. Right, I think our answer will get it from this part. Right, the chief financial officer of Living All is a registered chartered accountant. During the 2021 financial year, he had to appear in court regarding financial irregularities, which were alleged to have occurred under his direction. He denied his involvement, but was subsequently proved to have been lying in court. He then acknowledged that he had lied, but said he had been instructed to do so by one of the executive directors of the company. As a result, the CFO committed perjury and the court found him guilty of a criminal offense. Due to this outcome, Living All dismissed both the CFO and the executive director involved from their duties as from 30 April 2020. The litigation suit was finalized during the 2021 financial year and likely did not seem to have any effect on Living Well. All right. Now, if you can, the fundamental principles that, so we can say that the CFO failed to comply. With the following fundamental principles. Right. Integrity. Remember that we said according to integrity, you are supposed to be straightforward and honest. Then we can just say I'll be fast. You can expand like so that we can cover more. I'll just be summarizing. Then you can at your own time you can just expand it. But if you don't understand the summary, please feel free to let me explain further. Committed perjury and lied in court. And also caused financial irregularities. So because of that, his integrity is in question. He cannot be relied upon. We cannot trust him in everything that he does. Right. Number 2, objectivity. Right. He allowed the director to affect his decisions. Because when he said everything, he said that it was not him, it was the director who had caused him to do what he did. So at the end of the day, you are allowing biases to affect your decision making. So that is you are not in compliance with objectivity. You should not allow anything else to impair your judgment and your decision making and your reporting. Right. On competence, when we talk about fraud, it's sort of a thing that you knew that it was wrong. So normally we would not talk about mainly the competence, but you can also talk about it, but it's not a major issue, because we're saying if you're competent, you're supposed to comply with everything. But when you're committing fraud, like you know that this is wrong, that means according to your competence, you know what is right at the end of the day. So that becomes the competence becomes a minor issue in this issue. There's no issue of confidentiality here, disclosing any information, but there is an issue of professional behavior. Right, his behavior brings the profession into disrepute. Right, he's going to court, maybe it's on the news, then people are now saying, you see those accountants, that's what they do. Is that right? So that can then you can say that accountants, they don't comply with the law. You saw this guy, he was not complying with the law. That can bring a question to the profession. So those are the crucial. Of course, as I said, that you can even put a professional competence in UK. For example, when you are not properly doing your work, that can also be against. Maybe let me just put it also the professional competence in UK. Fail at what? Perform expected standards. As the CFO, we expect him to make sure that the financial statements do not have irregularities. But we find that the CFO is at the forefront of making sure that the irregularities are not properly reported. Any questions? So those are the fundamental principles. You just have to go on your scenario and look at pointers that can be in breach or that can cause threats to the integrity, objectivity, competence, confidentiality, and professional behavior of the accountant. Any questions? Right. So let me quickly move to the next one. Discuss, that's number 2. The matters that ISA incorporation should consider when deciding whether or not to accept Livewell as a new audit client. Right. From our previous sessions, I think you remember those things that we said you should look out for. Number 1, you should look at the financial reporting framework. Are they applying the correct financial reporting framework? Number 2, you should look at the auditee themselves. Is it a client that can be auditable? You are looking at the industry. Is it an industry that you can be able comfortably audit? Don't they have other things that are shoddy, which might even tarnish your image? The integrity of management and their attitude towards paying fees. Because as an auditor, you wouldn't want to be associated with things that can affect you at the end of the day. So at the end of the day, you have to understand the auditor that you are talking about, the client that you're talking about, is he auditable? When we're saying you have to understand the client, you need to find if the client is auditable. At the end of the day, you might find that maybe the industry that they are operating, or maybe some questionable decisions that they've made, they're a problem along the way. Is that right? And you also have to check yourself as the auditor on the preliminary engagement, audit engagement activities. You are looking at yourself, am I able to audit this client? Do I have the competence? Do I have the resources? We're looking at competence, capability. Do I have the independence? Is there anything that threatens my independence from auditing the client? Maybe the audit partner was working at the client as an accountant last year. Then maybe you might have to change the audit partner. Or maybe you have audited for more than 5 years. And you know that according to the Companies Act, you are no longer supposed to audit. Right, so you have to check all those things to see if they are there. So you audit. So we're saying you look at the framework, you look at the auditor, the auditee, can they be audited? You also look at yourself. Can you be able to audit the client? So those are the things that we look out for, right? So there are many things that have to be looked at, but normally for your exams, check if it's an open question. Like if you see that the question is like it's 6 marks, most probably just deal with the something that is on the scenario. But if they say 20 marks, then you know that maybe you can even go general. Is that right? So we have to be able to check the important issues that are within the scenario. Since it's 6 marks, that means you don't have to waver much from the scenario. You have to check what is there. Right. Let's go and check. I think I've read some of these things. Let me just check. So the things that you look out for, things like that integrity that we're talking about of the management. We saw that there is a CFO, although he was fired, you have to be able to check. Maybe there are other directors also who are like that. So can you work with such people? And I think we read something like this is a new audit. So this is a new audit. They were approached and they are trying to audit for the first time. Right. So we are being approached by Living Well. What is the industry? Living Well approached your firm to do the audit. Right. Living Well is in the business of selling natural and organic health products from a warehouse in Pretoria. Right. Most of the audit clients of this audit firm, they are in the retail sector. Most of the audit clients are in the retail sector, and Living Well is in the buying and selling. So that means we can also consider that we also have experience auditing businesses in the retail sector. So we're saying matters to be considered. So most of the clients in retail sector. Which can make it easier to audit a client in the same industry. Right. It's a first time audit. Normally, if it's a first time audit, you should be able to ask the client if they can allow you to have access to the previous auditors. Remember that all third-party communication, that is normally you pass through management, you tell them that maybe can I please talk to your bank? Can I please talk to your lawyer? Is that right? Consider if the previous auditor can be contacted. So you have to find out from them that is it possible for me to be able to contact your previous auditors. Remember that when you are auditing this year, the opening balances will come from the previous years. Right. Then we also have to consider.
Sir?
Yes.
When you said, when you say a first-time auditor, what do you mean by that?
You are auditing that particular firm for the first time.
Or it means that they are a new client, new?
Yes, a new client. So when you're auditing a new client, remember that although you might know the industry, there might be unique things in that organization. They might be using a different accounting system. There might be other issues. So normally, you might need to get an understanding of what happened in the previous years. Normally, you are auditing this year. but this year opening balances, they came from last year. So normally, as long as you're auditing, it's a new audit client, you need to find out if they can allow you to engage the previous auditor so that you can get an understanding of the previous year's audit. Then you should also consider the integrity of the management team. In light of financial irregularities and court cases. So you have to find out, can you rely, can you work with the management team? Can they not tarnish your image? You go there, you find that they're always doing things that are against the law. Is that right? Right. Then let's look for other things. Here I've just looked at those that I've already seen that are evident from the scenario. Right.
And against here, we can also see that these clients, they'll be able to pay our fees because I mean, their profit, it's growing each and every now and then. Is it right to?
Where is that? Yeah, that is a very good point. Where is that? Where is the issue of profit?
Where it says reported as 5 million, budgeted for 2021 was 4.9 million. So which means there was a growth. There's a growth in this company. The turnover for the 2021 financial year is reported as 5 million.
Yes.
Do we?
No, I want to see the growth. I'm not saying that. Okay, the growth that we can talk about is from 4.9 to 5 million,
yeah.
isn't it?
Yeah.
Yes.
What I'm saying is that do we have to write it as
yes,
well?
It's a very good point.
Okay.
Remember that you have to consider the ability of the entity to pay your fees. You have to consider the ability of it's one of the considerations that you have to make. Right, considering, did they talk about profitability or turnover? I want to check something here.
They spoke about turnover here. It's also profitable over the previous financial year. They also stated that.
Yeah, consistently profitable.
Yeah.
Right.
Yeah.
Considering that the client is consistent. Why I was checking my sister is because turnover does not mean profit. Normally, your ability will be expressed through cash flows and profitability. So, but since they also stated about cash consistently profitable over the years, which means they can be able to pay fees. One of the things that you have to consider is the ability of the client to pay audit fees. So that is a very good point there. Right. They must comply with the various local and international laws and regulations. Is that right?
Yes.
The auditor, the auditee must comply with various laws and regulations. Therefore, the auditor should satisfy himself themselves if they have reasonable knowledge or can be able to obtain relevant knowledge on the applicable laws and regulations impacting financial statements. So the fact that there are a lot of laws, there is a risk that you might go and audit and you don't look at some of the aspects that they are supposed to comply with. So that means you are not in the right direction. So you have to see, are we able to, do we understand most of these complicated laws that affect the financial statements? Not all laws, of course, but those that can have an impact on the financial statements. And even if you don't have, it doesn't mean that you can't audit. If you don't have, then can we be able to get that information? For example, we might say maybe we can get the statutes and read prior to auditing, or maybe we can say we also have our lawyers who can help us interpret. So it doesn't mean that if you don't know the laws, then you don't audit. We're saying, do we have an understanding of the laws? If not, are we able to get information that can allow us to effectively do the audit? Right. I think the next part does not have much. As part of a broad-based Black economic empowerment deal, Living Well is planning to expand considerably in the 2022 financial year. The deal will involve a listed company, which requires a Living Well to be audited. Well, to be audited externally for the first time for the 28 February 21 year end. As Living Well at a public interest score of less than 100, the company will independently reviewed in prior years by an accounting firm who is not registered to perform audits. As part of the BEE deal, the listed company will buy 80% of the shares in Living Well. The transaction will be finalized by the end of June after the audit report for the 2021 year has been audited and all the legal requirements have been met and registered. Right. There is something there. They are expanding considerably. The auditee will be expanding considerably. Therefore, the auditor should consider if they have the competence and capability, that is the resources, to audit a growing business. Maybe we're just used to auditing smaller businesses. So now this is now a big business which might need maybe more laborers. Do we have them? Or maybe more resources? We might have to do a lot of travel and stuff like that before we receive the audit fees. So are we able to fund all the activities that can make sure that we do an effective audit?
So the importance of the size of our firm, it's very
Yes.
important as well to look at it.
Yes, like it impacts the resources that are required. So it's especially on you. That means the resources that you might need. So that's how it becomes important. Because maybe if they are now having branches in all provinces, you might need to travel to all those provinces. You might need, instead of 3 auditors, you might need 4 or 5 auditors. So considering our other commitments and our resources, our personnel that we have, can we be able to audit them? I think those are the things that are evident from the scenario. In some questions, they can talk about a change in the accounting system. They can talk about maybe they've got special things, like, for example, they are dealing in jewelry, they are dealing in gold. So we can say, can we be able to find third parties who can help us in valuing their assets, which we we are not experts in gold. Can we be able to find someone who can value their assets and stuff like that? So first of all, whenever you're answering, try to first check what is already on the scenario, especially if the marks are small, the marks are lesser, marks like 610. Try to make sure that you get from the scenario. But there are some instances whereby they say 20 marks, 25 marks, then you know, and you see that from the evident information, maybe you are getting about 10 points, 11 points, 12 points, then you can go to the general. But in everything that you answer, don't just do what you call theory jumping, whereby you are just taking from the theory that is in the book and then you write. Relate most of the things that you are going to express there to the scenario that is given. Right. Right. Or number 3, I'm not going to, because we just did it now. Because number 1 and 2, I had to start them because we did them long back. I think number 3 and 4, I'll just quickly, so for just our friends, for the next 5 minutes or so, I'll just quickly tell them the things that we look out for. Right. When they say identify the inherent risks at the financial statement level, then describe the risk and assess the risk. Identifying, you note that this thing can cause the financial statements to be wrong. It increases the risk that the financial statements will be wrong. Then when they say describe, you now explain the description. Actually, on the inherent risk factors, we've got the inherent risk factors that we talk about, which are the change and stuff like that. I think I gave you in the previous class, if you still remember, when we talked about complexity, change, and stuff like that. So when those are the risk factors. That is a complexity, subjectivity, or uncertainty. We've got susceptibility. We've got change. Those are the factors. So there is complexity if it's a complex issue that the company faces. For example, they just acquired a subsidiary, or they were acquired by another company. Like what needs to happen with this company? That can cause a problem in terms of the reporting requirements in terms of groups. So that can create what? A complicated issue. So there can be complexity within that. Then there can also be an issue of subjectivity. For example, if we are dealing with provisions that are significant, normally they need judgment, and you choose the policies that you want. So you have to see, as long as something needs the opinions of the preparer of the financial statements, then that's subjectivity. Change, if there is anything that changed during the period, which is significant. For example, you can also talk about that acquisition of a new subsidiary, that can be changed. Introduction of a new accounting system, that can be changed. So anything that changed, we're talking about anything that was not there in the previous years, which came into being during the current year. They introduced a new sales system. They now used a Sage, which they were not using. Right? Uncertainty, these are issues that create cast doubt on things that will happen in the future. For example, there's a court case that might lead to the company being charged millions, which can affect the profitability and the operation of the firm. Then we can say susceptibility to misstatement. When we say susceptibility, we're saying there are conditions that are there, that are circumstantial, which can cause management to manipulate the financial statements. For example, in this particular case that we're dealing with, we read that these guys, there's a BBBE deal, and that deal is dependent on the audit report for 2021. So they will do everything in their might to make sure that that audit report is positive. So that would be susceptibility. So when we talk about the factors, those are the factors on this one. When they say inherent risk factor. So it's either complexity, subjectivity, change, uncertainty, and susceptibility. Those are the 5 inherent risk factors. Maybe let me just write them so that, and you can refer to the last recording. As I said, I'm not going to, because we just did it, so I can't just go through it, all of it. Inherent risk factors, they can be classified into complexity, if you are dealing with a complex issue on the nature. Let's say if they deal with a lot of actuarial issues. Subjectivity depends on the opinions of the users. Change, there's been a change during the period. Uncertainty, it creates unpredictability into the future. Susceptibility, management biases can result in manipulating the financial statements. For example, the bonus, the management are given a bonus based on profit, so they can be motivated to manipulate the financial statements so that they can get a high income, a high profit, so that they can get a good bonus. Right. So in this question, let me just point to the things that you could quickly look at. Right. Right, in the question that we have, we're told that all right, they were talking about the strong relationship. Let me just see what they talked about. The company sources both local and international wholesalers. So there will be complexity there, because they now have to deal with effects of transactions in foreign currency. So there are special requirements. So when we talk about complexity, all issues that have got special reporting requirements can create a complexity issue. Maybe you are dealing with a lease that we were not dealing with it in the previous years. That can create a complexity. Or maybe there was a change in the international financial reporting standard that can create complexity in the reporting. Right. So that one will create. So that one, you as a factor, you can say complexity. Then you can say the financial statements can be misstated due to failure to properly account for transactions in foreign currency and disclose them. Then they also said assess the risk. The risk is likely to be high. Because they buy a lot of things from the outside. Then we also have laws, compliance with various laws and regulations. That can also create complexity in the financial statements. You are now dealing with the regulations from various jurisdictions. There may be court cases that will be decided in future, so that can this one can affect your complexity. It can affect change because laws can change. It can also affect what do you call it, uncertainty, because there can be court cases that are yet to be decided. Right, but this one, the risk, you judge it as low. Why? Because these guys, they've got an exceptional team of legal advisors who advise them on legal requirements. So normally you assess the risk as high if there are no indicated safeguards that ensure that everything goes on well. Then it can be low if the company has got safeguards. So it's high if you can, like in this case, they are saying that we are told that they've got a good team of legal advisors. But of course, you cannot just say it's low. You have to assess that, is it true that they have got a good a team of strong legal advisors. Right. Then we can talk about there was an issue here to deliver products to some of Living Well's major customers. The company owns a fleet of mini trucks, of which most are between 2 and 3 years old. The account balance of mini trucks as part of the property, plant and equipment account balance is included as 3 million in the statement of financial position. The mini trucks are carried on the financial statements at cost less accumulated depreciation and impairment losses. Depreciation on mini trucks is charged on straight line basis over their estimated useful lives, which is indicated as 5 years according to the Living Well's accounting policy. During the 2021 financial year, it became very popular to customers to request that products are delivered to them, and therefore Living Well decided to include delivery of products to the customer's premises as part of their customer's service. Due to this decision, the frequency of trips that the fleet of mini trucks made to deliver products to customers increased substantially, which caused the mini trucks to break down more often due to the overuse. That creates uncertainty. Uncertainty in terms of estimates that can be but you don't talk about trucks. Remember that when you are dealing with the financial risks at the financial statement level, don't talk about particular line items. Talk about the financial statements as a whole. When we say a risk affects the financial statements at financial statement level, it will affect a lot of items in the financial statements. An item that affects a particular line item in the particular recording of an item, it's at the assertion level, right? So when you are expressing such a risk under financial statement, make sure that you don't state that maybe mini trucks and stuff like that. You just say they can be what a problem with estimates, right? Then I think the last one on this, we are told that the transaction will be finalized by the end of June after the audit report for the 2021 year has been obtained and all the legal requirements have been met. There is a deal. This deal depends on the financial statements. So there can be susceptibility because the management can be motivated to manipulate the financial statements so that they can be able to be successful in the deal. Right. So those are the things that we look at when we say risk at the financial statement level. And here the risk is high because definitely they want the deal to go to take place. So they will do everything that they can to support their decision. When we're assessing risk, we assess in terms of two things: magnitude and what likelihood. When we're talking about likelihood, is it likely to happen? Then the magnitude, the size of the risk. So then you can then say that a risk is high if we don't have enough safeguards to ensure that it can be covered. Right. So then you refer to the recording that we did on that. Then that is the last recording. Then this one at the assertion level with respect to mini trucks. Now we are now looking at the trucks themselves now. Right, did we do this one? Number 4. Or we didn't do it. So this one I will do it properly. So number 3, please, you can just refer to the previous recording. Right. Then number 4. So we'll start to do in detail from number 4. Right. Describe and assess the risks of material misstatements at the assertion level with respect to the mini trucks account balance in the statement of financial position. Right. When a figure is reported in the financial statements, there will be various assertions that management will be putting forward. These assertions, they are different. We have got what we call accuracy. By writing, by stating that in the financial statements that property, plant, and equipment is 50,000, management are stating that the property, plant were accurately calculated at 50,000. We have what we call completeness. They will be saying that all the property, plant, and equipment were recorded. Everything is, all the things were recorded. So when they say existence, we mean the property, plant, and equipment actually exists. It is there. That is reported. When we talk about cut off for transactions, we mean the things happened in the current year. They were not for last year or the previous year that are reported. Presentation and disclosure, we mean the transaction was accurately presented in the financial statements and the disclosures were appropriately made in the notes to the financial statements. So those are assertions that are depicted by what? By management. So when you are asked to assess the risk, you don't have to just look at all the assertions. Check the question, which assertions are they talking about? Right. In this case, they said we should look at the assertions that affect accuracy, valuation, and allocation. Right. So we have our, so please question 3, you can just check in the previous recording. Right. The risks of material misstatements. At the assertion level. Right. And what are we talking about? The mini tracks account balance. So when it's at the assertion level, you are looking at a specific account. So now, when they say the risk at the material statement means at the assertion level, and we are dealing with accuracy, valuation, and allocation, you have to look out for anything on the scenario that might lead to the accuracy, valuation, or allocation of the mini track being wrong. Already in my head, I will know that maybe the addition of the mini tracks might in the account might be done incorrectly. The calculation of depreciation may be wrong. They can use an incorrect useful life there. There can be any impairment which might not be recorded. Already, without even looking at the scenario, we know that what is it that affects mini tracks is an asset. What is it that affects the value of an asset? I know that is cost minus what? Accumulated depreciation. So for its accuracy to be wrong, that means there can be issues that affect the cost. So you are more on the things that will make it wrong than the things that are correct when you're looking at risks. What is it that can make the cost of mini tracks to be wrong? What is it that can make the accumulated depreciation to be wrong? What is it that can make the impairment loss to be wrong? Because they just say the mini tracks balance, you should be very careful. Because they can say mini tracks at cost. They can even ask about additions only. They can ask about the depreciation only, but here they say the mini tracks balance. And already I know that they can be cost, accumulated depreciation, they can be revaluation if they're using the revaluation model. So I will have to look for anything on the scenario that can affect that. If it's revenue, we have to see, okay, already if it was revenue, I will know, oh, they said they maybe they trade internationally, maybe the revenue might not be translated at the correct rate. The revenue might be calculated using wrong selling prices. The addition of the revenue might be wrong. If its purchases the same, is that right? So we have to look at the particular asset that we have. In this case, we've got an asset, so we have to go and link it to the scenario. So you don't just express in general, but I'm saying whenever you see a line item, already in your head, you should know the things that affect it. Right. So our main answer is here. So to deliver products to some of the living well's major customers, the company owns a fleet of mini trucks, of which most are between 2 and 3 years old. The account balance of mini trucks as part of the property, plant and equipment account balance is included as 3.3 million in the statement of financial position for the 2021 financial year. Budgeted for 2021, 3.1 million. Reported for 2020, 3.8. Right, the mini trucks are carried on the financial statements at cost less accumulated depreciation and impairment loss. So the things that we want are the things that affect those three things: cost, accumulated depreciation, and impairment loss. Right, depreciation on mini trucks is charged on a straight line basis over the estimated useful lives. There are two risks that I already see there. Right. There's a possibility that depreciation might not be calculated using the what? Reducing balance method, a straight line method. So there is a possibility that they might wrongly fail to use the straight line method. Right. So we can say there is a risk the mini trucks balance may be misstated as depreciation may be calculated using another method than straight line. So you answer it in a table format if they ask it, but this one there's no need for a table format. All right, then there's also a risk of misstatement due to using wrong useful life in determining depreciation. Because they said over the useful life. So the useful life can be wrong. All right. So instead of using, maybe you can say of not using 5 years to be specific, because the useful life is 5 years. So you can say there's a risk that, yes, you can ask.
Yes, I just want to ask, as you say, on this scenario, like in this scenario, there is no way by way they say just like they say that the company uses the straight line method, and then if you say there's a risk that they might another method other than this one can be used, and I just don't understand why will a different method be used, J?
My man, what we are saying here, when we are looking at risk, you are looking at anything that can be done which can cause the things to be wrong. If
Okay.
you are sitting here, you have not yet gone, you are on your own there. You read their policy, then you say, okay, what should I look out for when I go there on the ground? So you say, okay, their policy is to use straight line. So when I go there, I should check, are they using the straight line?
Okay.
Because there's a risk that by mistake, they can use a different method. Or maybe the person doesn't know that this is the policy, might use a different method. So there's that possibility that a wrong method can be used.
Oh, now I get it.
So it's you sitting on your own saying, okay, I want to go and audit mini trucks. What are the things that I should check as an auditor? You are not saying it's wrong. No. You are saying there's a risk that they can use the wrong method. So I should go and check, did they use the straight line?
All right, I get you.
Yes. So the things that when you're at the risk assessment, you are just looking at things that can possibly happen. You are not saying they happened.
All right. Continue.
If you planning your audit, checking the things that, okay, when I go to the mini tracks, what are the things that I should look out for? Okay.
All right.
Right. Then during the 2021 year, it became very popular for customers to request that products are delivered to them, and therefore, Living Well decided to include delivery of products to the customer's premises as part of their customer service. Due to this decision, the frequency of trips that the fleet of mini trucks made to the deliver products to customers increased substantially, which caused the mini trucks to break down more often due to overuse. Yes, you can. You are very right. You can state here that, in fact, they are all about accuracy, valuation, and allocation. So you'd find that it's one category: accuracy, valuation, and allocation. So actually, here there might not be any need for us to specify. But when you are testing the other that's when they can ask you to specify the assertion. But normally, accuracy, valuation, and allocation, we just take it as one assertion. So our assumption is that everything that we're looking at affects the accuracy, valuation, and allocation. All right. This thing already, you know that they are making a lot of trips. From an accounting point of view, then you know that already there's a risk that there can be impairment issues. Remember, when the capability of an asset is now in doubt, there's a possibility of impairment. You are also applying your FAC skills here. There's a possibility that the asset might be impaired. When we say it's impaired, we mean the carrying amount is now more than its recoverable amount. They might have recorded 3 million there, but the asset might be having a fair value on the market of 2 million because of its overuse. Remember that carrying amount in the books is just a product of accounting policy. It doesn't look at the state of the asset. Of course, sometimes we review the remaining useful life. Right. So we can say that there's a risk that the remaining useful life might not be. Okay. So here I'm saying due to increased use, there is a risk that depreciation may be misstated as the useful life being used might not reflect the remaining useful life. Remember that according to IAS 8, they should always, and IAS 16, they should always check if the remaining useful life remains relevant. As long as the useful life of the asset is in doubt, we have to what? We have to adjust the useful life and account for a change in accounting estimate. Right. Then I was also saying there is a risk that impairment losses may not be accurately determined due to increased use of the trucks. So they have to test for impairment. I don't understand your question, Roshan. I just see that you said, what about valuation of the fleet of trucks? Right. You remember that we are new auditors. Maybe rephrase your question. There's a risk that the mini trucks may be misstated due to wrong opening balances. Is financial statements were previously only reviewed by a person who is not a qualified accountant. I think I read something. I'm coming to what the gentleman or lady is asking there. I think I read something that prior to this current year, if I still remember quite well, they were being reviewed. Right? They said that prior is who is not registered to perform audits. So the auditor was not registered to perform audits. So maybe we don't know if they did quite a good work. Remember that when you are calculating the mini trucks, if the opening balance is wrong, the accuracy of the closing balance will also be in doubt. So we would also have to check. Yes, I see what you are saying, but what are you saying? What is it that you are saying there? I need to understand your Roshan, that you are writing about. What is the risk? What is the risk that you're talking about? Right. Yes, I understand that you're talking about the valuation of trucks, but what is the risk? We have to describe the risk related to that. Right. There is a risk that the costs used in determining depreciation may not be correct. We have to relate that to the assertion. Okay, Roshan is saying this is 3 million. The reported budgeted was 3.1. We can see that the difference is normally we know that the budget might not come out as the correct one. So there's a possibility there. Right. Then a 3.8 for 2020. But it can be reasonable. The changes are reasonable. Because they can be 3.8 and then because they didn't buy, there was depreciation, that's when they can move to 3 million this year. And the budget, it was 3.1, maybe because of, maybe I think the difference is not all that big. So I wouldn't think that there will be much of an issue there. Right. I think those things that are evident from the scenario, they are 9 marks. So maybe you have to make sure that your points are almost 9. We are on 6, right? You can even say that, but now, first of all, you start on the scenario. Then if on the scenario you don't get enough points, because if they say 9 marks, try to make sure that you are around 9, around 9. Right, and we have to check, did they say we should also assess, or some of the marks may be on the assessment. Describe and assess. Okay, so we also have to go on the assessment, right? So maybe let's go to the assessment if we, right. Right, because of the increased use of the trucks, the risk of material misstatement on the balance of mini trucks can be assessed as high. As there is high likelihood that depreciation and impairment may be misstated. So here we're looking at what as uncertainty. There is uncertainty on the useful life, and the balance is susceptible to misstatements. Ensure a healthy balance sheet. Considering a deal which depends on the financial statements. Yes, mini trucks may be overstated. So for this point, don't just talk about the overall financial statements. You should go where you are saying, because we're saying here there's a deal that they want to make, which they want to go through. So for it to go through, they should have a healthy balance sheet. And one of the important things are the assets. So they can manipulate these assets so that they can be able to have a healthy asset balance. Right. So that's the assessment. So the risk will be assessed there as high. But if there were no issues, if everything was straightforward, let's say they say they didn't buy any new trucks, like those things of the straight line method, we know that the risk will be low, that they can use a different method. The use of the useful life, the risk is low, that they can use a different, you can just check, but the risk is low. But now the doubt over the useful life because of the increased usage, that is the main thing that drives us to think that this area should be audited very well, because there is high risk of misstatement. Any questions there? Right. Next thing. Calculate planning materiality. Calculate your planning materiality. Right. When you're calculating a planning materiality, there are things that you have to follow. You have to understand when you are. So I will do a detailed. Here they only had 3 marks, so maybe you was just supposed to summarize. But maybe for the sake so that we know how to do it, I would just take you through so that you already know, even if you are given a longer question, maybe it's 10 marks, 15 marks, you know how to do. Right. Your step number 1. Planning materiality. Step 1. Determine which figures to use. Right. Normally, you use the figures for the current financial year if they are the unaudited figures if they are available. Right. So we are saying use current year budgeted figures. Actual figures, sorry. They are available. Right. Materiality. In fact, when we talk about materiality, you are trying to gauge which amount can you use to judge that an amount is material or not. Materiality can be measured quantitatively or qualitatively. When we say quantitatively, it's in terms of the amount. You can say all amounts below 1 million are not important. So those misstatements, if you add them up and they are less than 1 million, you can say there are no material misstatements. You can even give an opinion that there were no material misstatements. Then if they reach that 1 million, then there's a material misstatement. So when they say planning materiality, that's your what? Your threshold of the threshold amount for determining whether an amount is material or not. Right. So we have got various bases that we can use to determine the materiality. Turnover, gross profit, net profit, total assets, and equity. Right. So all the figures that we are given, if you still remember, we are given the turnover. Right. So we can use the turnover of, we have the one on the financial statements, which is 5 million. So if this was not there, we're going to use the what? The budgeted. And there are also various reasons why you might not use the figures for the current year. For example, if you know that you doubt them very, very, very much, there are issues that make you doubt those financial statements, which are very clear that these financial statements, they can't reflect the truth. Then you can use the budgeted figures. So if we can't use the actual, normally, if the actual figures, the unaudited figures are there, you should always use the unaudited figures for this year. But if not available, use the unaudited figures. So use the budgeted figures. But the budgeted figures can only be used if there were no major things that happened during the year that make the budget irrelevant. For example, if there was Corona and we only operated at 30% of normal capacity, then that budget becomes useless. We cannot use it. So if the current years and audited figures are not available, it's possible that they cannot be available. Maybe they're still compiling. And if the budgeted figures cannot be used, maybe you saw that they're unrealistic, then you can use the prior year actual figures if they were audited. But again, the prior year figures cannot be used if there were major changes that happened. So we're saying our first port of call is the current year's unaudited figures. If not available or not to be relied upon, go to the budgeted figures for this year. If they cannot be used, go to the previous year's actuals, which were audited. So in this particular case, we would use the one for the current year since they are there. All right. Then the second step, you have to consider your indicators. There are various indicators that you can use to determine materiality. You would find that in most of your exams, they will be given. In fact, I've never seen them as requiring you to know them. When we say the indicators, these are these ones. That materiality, normally, there are standards that most firms use, right? Turnover, that means 0.5% to 1% of turnover, it becomes immaterial. The 0.5, we call it the lower end. Then the 1%, it's the higher end. If risk is high, you take the lower end. If risk is low, you take the higher end as your materiality. So these are what we call the indicators, right? So there was no need to do all this in your exam because it was only 3 marks in this particular test, right? But because we're not in the test, I'm just going through everything so that in case the question is different, it needs everything. So we have your indicator, then interval. Right, the indicators that we have: turnover, gross profit. You know what? Do we have gross profit there? I saw turnover, but let me just make sure. Turnover, gross profit, net profit before tax, total assets and equity. Net profit before tax. Total assets, equity. (0.5% to 1%). 1% to 2%. 5% to 10%. 1% to 2%. 2% to 5%. These are our indicators. Then so you now know your indicators. That's your second step. Right, the third step. Determine which of the indicators are appropriate. Right, a turnover, you use it if the sales are stable. and the business is its performance is highly judged based on the sales. Right. A gross profit, a profit before tax, we normally use it if the business is profit oriented. That is if the main focus of the business and its judgment is based on profits, and these profits are relatively stable. But if the profits are changing drastically, then we can opt for the gross profit. But so normally we would opt for the net profit before we consider the net profit before the gross profit. The total assets are used if the business is capital intensive. If the business is capital intensive, then we can use the total assets. That's when we use the, but equity is normally determined as not being a very good indicator. Equity is not normally used as an indicator. All right. Sorry, just a second. I'm coming just now. Right. So we're saying use sales if the business is sales oriented. That is volume of sales. Is the major line item defining objectives. Maybe their target is like all their targets and everything is based on targeting to have as much sales as possible. Right. Then use profit. Before tax. We normally use before tax because the net profit, we usually take it as being affected by the taxation, but it can also be used sometimes before tax if business is profit oriented. When we say it's profit oriented, we're saying its objectives are centered around the profit, their targets and everything. When you say they're sales oriented, they're going to be a business that targets to reach a certain quantity of sales. Right. If volatile, then use gross profits. When we say it's volatile, that means it's drastically changing. That's when we can then go down and look at the gross profit. Right. Use total assets if capital intensive. Those companies that have got a lot of assets, we use a lot of machinery of high value, then you should use the assets. You can use the assets. Equity is not normally considered. A good indicator. Equity, they don't usually consider it because it might not be related to what is happening within the business. Right. So in this particular case, one thing that I saw when we were reading the passage, we were told that this business is not capital intensive. I think somewhere I read where they were talking about the business not being capital intensive. Right. The company is not capital intensive and it does not own warehouse from where they operate. Right. So we're saying in this particular case, so this one you will not be putting on, like you will not be recording on the answer. This will just be for you. So we can say that the total assets cannot be used as the business is not capital intensive. Is that right? Net profit is not available. So the capital assets, they are not available, but even if they were available, we're not going to use them. Gross profit not available also. But from the information given, if they were available, there's nothing that was going to stop us to use the gross profit. So the three things that we could use in this particular question are turnover, gross profit, or net profit. We could use those three. All right, since we have the sales, we are going to use the what? The sales. That's what we're going to use because that is what is given. So the indicators, you don't have to choose one. All that can be used in that particular question, use them. All of them. So if you see that all four can be used, use all of them. Step 4. Calculate the materiality interval. Interval of each suitable indicator. Right, the only indicator that we have in this particular case is sales, turnover. So we'd use our turnover indicators. They would be 0.5% times the unaudited turnover. Remember, we said that we're using unaudited figures because they are available. The unaudited turnover, it's 5 million. This unaudited turnover, 5 million. So if it was not there, we're going to use the budgeted. If both were not there, we're going to use last year. But since we have it, we're going to use the 5 million. So when we say the interval, you calculate the 0.5%. Our indicators are 0.5% and 1%. So you calculate the 0.5% of 5 million. Right? To what? What do we get? Maybe let me just put it down there. $5 million times 0.5%. What do we get? $25,000. Right. Then we can take the middle ground. 0.5 to 1%. The middle ground is about 0.75. So we can say 5 million times 0.75%. I will tell you what does this mean now. What do we get? $37,500. Then 5 million times 0.1%, the higher one. What do we get? $50,000. So these are the levels. This one is the lower end, mid, then higher end. So we can choose any of those three alternatives on the turnover. So if profit before tax was a suitable and with the figures, you're also going to calculate the three. That means for profit before tax, you could take 5%, 7.5%, and 10%. If assets were there, you could take 1%, 1.5%, and 2% of the assets if they were a suitable indicator. So you calculate for all of them, right? Then after calculating for all of them, then you now come to the last stage now. That's when you now determine your what?
Sir? Sir? Hello? Hi,
I
sir.
can hear you. You can go on, I can hear you.
There's 0.75%. How did you get it?
The middle ground of 0.5 and 0.1. You can say 0.5 plus, it's what was it? 0.05. What was it? Sorry, I think it's 0.5 and 1%. This one is 1%, not 0.1%. Is the, you can just say the midpoint of 0.5 and 1. You can just say 0.5 plus 1 divided by 2. If you're on this one, you can just say 1 plus 2 divided by 2, sorry. This one, 5 plus 10 divided by 2. So for this one, we said 0.5 plus 1 divided by 2. That's your middle point. Are you answered? Right, then you decide on the materiality figure to use. Right. Your rule is that if risk, hello?
Please just repeat what you are saying about dividing, find the middle.
She was asking where did I get the 0.75? So I was saying that you can just take these two figures that you are given as the interval, add them and divide by 2. You can get your middle.
Okay.
Like 0.5 plus 1 divided by 2, you get the 0.75. Right. When you are deciding on which figure to use, if risk is assessed as high, use the lower end. If risk is assessed as medium, use mid-end. And if risk is assessed as low, use upper end. Right. So considering that risk was assessed as high, the materiality will be measured at the lower end. Remember, we're talking about the fraud and those other many issues. And most of those risks were just putting them on the higher end. So that means our overall risk is assessed as high. So we'd use the materiality to be 25,000. So if risk is high, take your materiality to be as low as possible. So if we turnover, we'd accepted turnover, we'd accepted assets, we'd accepted profits, you would take the one with the lowest if the risk is high. Of all the categories, you find the one with the lowest, that's the one that you take. But if the risk is, you have assessed the risk and you have assessed it as low, then you could have taken this 50,000 as your materiality. So when we say 25,000 is our materiality, we mean if we discover a misstatement and it's below 25,000, then it's not material, unless if it's qualitatively material. If it's an element of fraud, whether it's 5 rand or 20 rand, it can be material in some instances. So in terms of quantitative, materiality, when we say our planning materiality is 25,000, then we're saying any figure that is below 25,000 can be considered immaterial. That means it's not important. It cannot affect the decisions of the user. Then 25,000 or above. And when we say planning materiality, we mean all the misstatements added together. We're not saying one by one. If we take all of them together and add them up, so it's when we talk about materiality, we look at materiality individually and we look at materiality in aggregate. That means after adding together the misstatements from the various line items. As long as they are 25,000 added together, that means the misstatement becomes material. Although individually they might not have been material. So these are the steps that we have to follow when we're determining materiality. Right. Then maybe what I can do, later on, it's only that I don't have the things in the machine that I came with. I can just maybe send, let's say check around 7. I can just send a question whereby I can, with explanations on whereby we can use multiple indicators. Then you can just check the difference. This one will only get one option, which was the revenue, but you can also have various options in a question. So I will see around 7 when I'm at my place. Then I can be able to check in the other machine. Then I can send you. Right. Then the last part of the question. Okay, they also wanted the performance materiality for mini trucks. Performance materiality for mini trucks. Right, performance materiality now would use the percentage that are given here. You evaluate as an auditor the percentages that you can use. Right, like in this entity, the audit firm has got a set performance materiality levels. So according to this audit firm, their materiality levels, performance materiality is set as this. If the risk is high, 70%, they mean the performance materiality will be 70% of the planning materiality. If a risk is medium, 80%. Remember that the planning materiality is for the overall financial statement. Now the performance materiality will be for a particular balance that you are auditing. So it will be lower. Right. So remember that the mini trucks we assessed is high, the risk, because of the use. So we're going to use 70%. But if we had assessed the risk of, if we didn't have those issues about the mini trucks being overused, and if we didn't have any new trucks or everything, if it was normal like always, we could just assess it as low, especially if we audited the balance last year. Then if it's low, we would use the lower spectrum, the higher spectrum, that is the 90% there. Right.
So to answer that one, you can just write high 70%.
You have to write the justification.
Oh, okay.
So we can say what? You have to calculate the amount. Right, considering that the risk of material misstatements on mini trucks balance was assessed as high. The performance materiality will be determined using 70%. So this one will be for line items then. So we'd say our performance materiality. So it will be a percentage of the planning materiality multiplied by 25,000. What do we get? 17,500. That would be the performance materiality. Any questions? So your assessment of risk will determine. Questions, right? Identify and describe the aspects that the auditor should consider when developing an overall audit strategy. Your answer should focus on the scope of the audit strategy. All right. When you are determining your scope of the audit strategy, you are trying to look at when you are saying your audit strategy is how you are trying to you proceed with your audit. That means you did the planning, you now know your materiality. Now you want to see how you can be able to proceed with the strategy. So in an audit strategy, we consider three things. In an audit strategy, we consider three things. When it's high or low, like what you can be given at the 70%, but whether it's high or low, it's you who determines. Remember that it's us who determine that the risk is high. So it's you who should analyze the situation and determine if the risk is low or high. Right. Audit strategy. Audit strategy involves the following. Which are the range of activities to be performed? What are you going to cover in your audit? Then timing, when to be performed. Then direction. These are the areas of focus. Right. Let me just quickly within talk about one or two, just very few things that I think can be important. Right. You have to look at all the factors that can affect the scope of the audit. Right. The issue is this entity must comply with various laws, local and international regulations. So the company must comply with various laws and regulations. So you have to have an understanding of the various laws and regulations that will be affected by the company. Right. Then we also have to know that the company recently increased the public interest score. Which necessitated an audit. Then was previously reviewed. So all these things can affect the scope. That is what you are supposed to cover as an audit. Because already from this information, you know that, okay, I should look at the opening balances. So you will be considering these things that it's your first time, like there are a lot of laws that have to be involved. Is that right? Then there was what? There were financial irregularities. And fraudulent activities. So those things can affect your scope. Right. Then when we are looking at the timing, it's when can you do the audit. You have to look at the deadlines. Maybe when is the audit supposed to be finalized? By what time? Let's say maybe there's a tight deadline. No, you answer according to the scenario. You have to look at the scenario, and that's why I only talked about the relevant things there. In another question, they can tell you that the company is planning to list on the exchange. Then you have to look at that. Or they can say that they've got an internal audit function that is well-resourced, which does its job well. That will affect your scope. Remember that if they've got a functioning audit, internal audit, you might not have to do a lot of work. Then you can be told that they've got a new accounting system which was not there in the previous years. Those things will affect the direction. Or maybe there was a new management team. They removed the old management team. That can affect your direction. So you answer according to the scenario. Is that right? But now I'm talking about, like, on timing, we don't have any things that are there on the question there. So that's why I'm just looking at the general there. So that's why you see that I'm looking at these general things, but normally you should deal with the things according to the scenario that we have. Right. Then you might also look at things like maybe stock counts that might need to be done. I'm just here. I'm not saying this is how you sort out the timing. I can send a document also with an audit strategy, maybe a question and an audit strategy, but I'm just talking about the things that you can consider. All right. You can also consider the reporting timeline. When are you supposed to report to top management? Maybe when are you supposed to do your reviews? All those things. So when we're talking about timing, when are you going to do the procedures? For example, if you're going to do a surprise cash counts, when are you going to do them? There are things that are supposed to be done before year end. If there's a tight audit deadline, then you know that there are some procedures that you can do during the year before the finalization of the financial statements. So that by the time that they finalize the financial statements, you only have a few things to do. Right. Then the direction. It's to which areas are you going to direct your audit? Like in this case, purchases was a high risk area. Why? Because they were acquiring from what? They were acquiring from organizations outside the country. Then we look at things like there's purchases. Then we can talk about the mini trucks. So your direction is from your analysis of risk, which are the interest areas that you are going to focus on as you look at the as you try to have an audit strategy. So like in this case, I think these are the two areas that are evident because they've got imports. Then we should focus on the purchases. So in your direction, you don't just write purchases. You have to state that, okay, purchases will be a focus area because a lot of items are imported and there might be issues related to foreign currency reporting. The mini trucks, because of their increased usage, then I might also have to look at it's your plan, your strategy. You are not reporting to the audit. It's your strategy on where, like, okay, from your assessment of risk, which areas, which areas are you going to focus on your audit? The internal controls will affect, yes. They are not like the internal controls. You have, remember that you will have assessed all the internal controls. Then you can then determine the direction that your audit will take. You can do an assessment of internal controls, maybe because of the fraud that took place, like in this case, to see if everything is in order. All right, so I think, please, I think I will be able to do that between 7, but before 8. Please check the document that I will send. I will make sure that I incorporate the materiality where there's more than 2 things that you can use, and also the audit strategy. So I wish you all the best, and I believe that you can pass. And please, in auditing, the main reason why people fail is there are 2 things. Number 1, you are just writing theory. Link to the scenario, please. Whatever question that they ask, risks, don't just take in general. But I told you that if you see that, okay, these are 20 marks and the things that are evident are 4, 5, then you can go general. But most probably, link whatever you do to the scenario. Then number 2, use auditing language. So there may be things that are correct in English, in normal day-to-day English, but in auditing, they expect you to use auditing language. Of course, at this stage, we are not yet deeper into that. But as we go, you should know that we should know how to use the auditing language when expressing yourself. Okay, wish you all the best, and God bless you richly, and I know you will pass. Thank you so much. Now, I'll send the recording soon. I'll just have to run it, and I'll do it early today. Thank you so much.